At COP29 recently, the UK reconfirmed its ambition to spend £11.6 billion in climate finance by 2026. We also saw a tripling of global climate finance commitments to $300 billion a year. The rulebook for carbon markets under Article 6 was finally agreed, giving a major boost to carbon markets. And the potential here for Ethiopia, I think, is huge. But the latest work by Lord Stern estimates that 2.4 trillion of climate finance will still be needed globally by 2035. So we're some way off the necessary trajectory, especially for Africa, where investment needs are estimated at nearly $300 billion a year, and echoes what Hikmet was saying about the challenge for Ethiopia too. In Ethiopia, the UK is already playing a role in attracting more climate finance. We co-chair the Climate Resilient Green Economy Forum, and under this, the Climate Finance Task Force. We're also supporting the government of Ethiopia to access more climate finance through our program with the Global Green Growth Institute, which has already improved Ethiopia's access to the Green Climate Fund and the Adaptation Fund. And it's also designing a legal framework for national carbon markets. But as capital markets take off in Ethiopia, and I really believe they will, they present a new universe of financing. And it's essential that we take this opportunity and steer their direction towards achieving green and inclusive development in Ethiopia.
Our economy is already bearing the brunt of climate change, with annual loss estimated up to 1.5% of GDP, a figure projected to rise to 5% of GDP by 2040. Degraded land, recurring droughts, and other climate-related disruptions further emphasize the urgency of building resilience through innovative financial solutions. Despite these daunting figures, there is a significant opportunity ahead of us. Ethiopia has successfully mobilized billions of euros in climate financing in recent years. Ethiopia have also set an ambitious target to reduce greenhouse gas emissions by 68.8% by 2030. Achieving this goal, as outlined in our nationally determined contribution, is estimated to mobilize a cumulative of billions of investments. To bridge this gap, the scoping study outlines a diverse array of promising green finance instruments, from thematic and impact bonds to carbon credits and blended financial mechanisms. Importantly, it also emphasized the need for strong enabling environment, one that includes robust instrumental capacity, coherent policy frameworks, and vibrant public-private partnerships. These elements are essential to attract both domestic and international investments to a scale required. As we gathered here today, it's important to remember that our responsibility goes beyond policy and finance. We are stewards of this land, not only for ourselves, but for the generations yet to come. Ethiopia, which is rich in natural heritage and cultural legacy, calls upon us to act not just as decision makers or investors, but as caretakers of nature. This is a sacred task, one that asks us to align our economic system with the rhythms of nature and long-term well-being of our communities. As the late Professor Wangarai Matai so eloquently said, we are called to assist the earth to heal her wounds and in the process heal our own indeed, to embrace the whole creation in all its diversity, beauty, and wonder. Let us be inspired by these words. Today's discussion goes far beyond finance. It's about safeguarding Ethiopia's sustainable development. It's about aligning our economic strategies with climate resilience, creating incentive for innovation, and unlocking the full potential of our private sector to drive green growth.
So I think before we delve into the whole green finance area, it's good to have some foundational concept of what it is. And again, also to acknowledge that there is no universal definition of green finance. However, we can understand it through the objectives that it aims to achieve. And this will be low carbon and resilient development, reducing financial risks that the ecosystem is exposed to, as well as steering economic development. And you can see here how they the crossover between green, sustainability, and social. So we understand when they're talking about green finance, it also includes climate. Climate is always included within green finance, as well as anything that will be tagged blue or within the blue economy with the oceans and freshwater lakes, as well as nature in itself. So this is what green finance encompasses, as well as sustainability. So there is a relationship between these terms that are used, but then we also need to acknowledge that there's no universal definition for it. So it's most often defined by the objectives that it aims to achieve. And how is green finance mobilized? This is through the 3 traditional asset classes that we have, or the categories of finance. It will come in through as debt, where you have an obligation to repay amount. It could be equity, where there is some shares or ownership that is being exchanged, as well as others, which is risk sharing. And we can see some examples of how green finance is channeled. And here we have concessional and unconcessional notes. We have result-based bonds, as has been mentioned earlier about green bonds. And they are very good examples from across Africa, and the various green, social, and sustainability, in short is GSS, that have been issued across the continent, showing a very good track record of various countries taking advantage of these opportunities in the market. And we also have them as capital and equity. This will come through public-private partnerships. It could even be budget reallocations within the public financial management system, as well as various financing facilities and climate funds. And I think a good example is Ethiopia's own public-private partnership, which is the issuance project. And you also have various other examples across the continent, like the Congo Basin Forest Fund, and Rwanda's Catalytic Green Investment Bank. And we also know that green finance can be channeled through risk-sharing mechanisms. And this is where we are either de-risking because there's a certain perception in the market. For example, if there is not much penetration in the market of a certain instrument and we want investors and we want other stakeholders to participate in it, then you have an institution or an individual or even government itself taking part of that risk so that they can be able to catalyze investments and capital flow in certain projects. And this is how it's actually channeled through various instruments like contingent credit. You have securitization, as well as guarantees, which has been a very useful instrument in the issuances of green bonds, especially in untested markets. So, for example, Ethiopia, which has not launched a green bond, it will be good to have a guarantee so that private investors feel comfortable to put up their capital for these kinds of investments. And there are various examples across the continent. There's a solar securitization, and actually World Bank is planning to issue a drought catastrophe bond in 2025, so that will be interesting to watch out for, as well as various contingent credits that are offered. And it's good to know that these instruments are constantly evolving as the landscape is changing, and there's deepened understanding of various terminologies as well as aspects around green finance. So what did we do? As I mentioned earlier, we conducted desk reviews, and we used this framework to be able to guide our desk reviews. We looked at the economic and fiscal needs for the country. We looked at the credit risk profile, looking at the credit risk assessments and the presence of guarantee mechanisms that could be used to increase the channel of this green finance, as well as the various green activity levels in the country and the mechanisms to monitor them. Because since you have something tagged as green, there is certain metrics and progress indicators that you really need to monitor. verify and report on. And then also some of the sectors that have been prioritized, I think we saw agriculture, energy, water, and transport as well, but we'll speak more to it later, as well as the capabilities that are needed in the market. So if it's what is the skills level, what is infrastructure that is there, how do we align to existing frameworks? Because here we do not want to create something new. So what can be done with the existing policies, with the existing instruments, with the existing institutional frameworks that we already have, and maximize on them. Thereafter, we also had stakeholder engagements, and we had engagements through 5 broad stakeholder groups. We spoke to development partners, we spoke to environmental stakeholders, who have been mandated with ensuring environment protection and conservation in the country. We spoke to legal, political, and regulatory stakeholders, because for you to be able to channel green finance successfully, you really need government support, and government needs to provide that signal to the market that it's ready to do this and how it's going to do this. As well as the demand and supply side stakeholders, because who is looking for these instruments in the market, is there appetite for it, and who is going to supply it into the market. And then finally, the development finance institutions.
Kenya is an excellent example. It's one of the largest producers of renewable energy, not just in Africa, but for the world. You're also building data centers in Kenya to address shortage of computing infrastructures. And as energy is becoming a critical infrastructure to power the data centers in the future, we would love to hear your perspective on the interventions required to ensure Africa gains enough computing infrastructure to power its AI.
Energy, reliable energy, clean energy is extremely critical for us to advance, particularly in the area of technology, and indeed in a lot of the things that Africa ought to do. In Kenya, our grid is about 93% green energy, renewable energy today. And it would be important that we all factor in that so that we have clean energy, green energy as we go forward. I also want to state that one of the things that we are doing as we look at AI is to be able to establish data centers that are also powered by green energy. And there's a very serious conversation that is already taking place in Kenya, and hopefully we shall be able to have this. And this is happening around Naivasha area, where we are promoting geothermal energy as something that can lead us to achieve this particular thing of having reliable energy. But we need to also look broadly on how we invest in the energy sector, because we have made it quite expensive, in my view, for people to invest in the energy sector on the continent. We need to look at it critically. What incentives can we give so that those who want to come in, particularly on solar energy, wind energy, hydro can be very expensive and protracted, but it would be something good if we can also have it, so that we can accelerate the production of, expand our capacity in energy to be able to anchor the artificial intelligence that we are looking at. So that, to me, becomes very, very critical. And policymakers on the continent need to look at this specific area very, very critically. The other thing that I would then quickly point out is that we need to quickly re-engineer our own thoughts on the continent. Our two heads of state have spoken on the need for health, improved health infrastructure, agriculture, and so forth, especially with the AI. I think as a continent, we need to not allow ourselves to be driven by fear. Fear should not drive us out of town on this agenda of artificial intelligence. We need to work closely, coordinate as a continent, and make sure that we direct resources to upgrade our capacity in artificial intelligence and in technology as a whole.
This year in Cape Town from September 29th right on to the 3rd and the 4th of October, we are going to really deal with signing new energy contracts that will come into developing our upstream energy sector. I'm excited when I look at what we'll have around the Just Transition concert. It's going to be amazing. Nobody can doubt us when it comes to putting together a great show. Our finance forum this year stands to bring in no less than $20 billion in deals that's going to be signed. It's really important to be part of that. Take a look at our agenda, be part of it, don't hesitate to reach out, and let's go make Africa proud. Let's continue to produce energy for human flourishing. It's time to unleash our true potential.
The State of Energy Innovation is the first analysis of its kind. It provides a comprehensive global review of what's happening in the important world of energy innovation, and it identifies key challenges that are emerging. Based on the latest data from dozens of countries, it tracks recent technological advances and significant trends on policy and investment.
The fact that energy innovation is in the spotlight should not be a surprise to anyone. Innovation just simply cuts through too many important energy policy goals, from raising the competitiveness and environmental performance of existing industries to establishing and competing in whole new sectors, such as clean technology manufacturing, to improving supply chain security and resilience, to improving affordability of energy products and services, to facilitating energy access, and of course, to addressing climate change. Such innovation progress is notoriously difficult to measure. There are no simple and easy metrics to quantify technology progress through the stages of their pre-commercial development. This is a problem because intangible progress does not easily get the attention of decision makers. And there's always a risk that innovation support is cut back at times of competing priorities, even if the underlying challenges of energy security, of competitiveness, of climate change, etc., even if they don't go away. Against this backdrop, we have developed this new State of Energy Innovation report that we are releasing today, in which we have assembled a large range of data sources and metrics to illustrate the importance of innovation, to highlight progress, and to identify potential action areas, all to assist decision makers in making the right choices today that can deliver on the key policy goals of tomorrow. The report shows three important things in my view. It shows how energy innovation has delivered for key low-emission technologies like nuclear, solar PV, or electric cars, but also with pioneering work that was spilling over to other sectors of the economy and for wider macroeconomic priorities such as diversified trade balances. The report also shows how energy innovation is performing. Apart from the wealth of data and metrics across patenting, venture capital, R&D spending and more, we identify some 150 innovation highlights from last year in our report, based on a survey of nearly 300 experts from around the world, as well as priority areas where we think some critical milestones towards commercialization are achievable within the next 5 years or so. The report, finally, as a third element, also shows how energy innovation can be fostered. We acknowledge, of course, that each technology has its own unique challenges, so there is no simple or single recipe to success. In fact, we do recognize that innovation requires time and patience just as much as it requires genius and finance. It is vitally important that decision makers remain tolerant of projects that do not turn out as expected, but nonetheless provide those important learnings that may facilitate the next step in the innovation journey.
A few examples. So today, nuclear energy is a mainstay of global electricity generation. Much of it was deployed in the years following the 1970s oil crises, but that growth was fueled by research. In response to those energy crises, by 1980, IEA governments were spending nearly 0.06% of their GDP on public nuclear energy R&D. That's actually a higher share of GDP than they spend on all energy R&D combined today. But the benefit for the energy sector was tangible. Nuclear helped moderate oil and gas demand for power plants, and it helped to diversify energy use. At the other end of the spectrum of power generation, in terms of scale and accessibility, solar PV has become the cheapest new source of electricity in most countries of the world in recent years, driving its exponential adoption. In 2024, generation from solar PV rose by 480 terawatt hours, according to the Global Energy Review that the IEA released just last week, and that's more than the total annual electricity demand of Indonesia. Yet this outcome did not, as you might say, fall from the sky. The journey of modern solar PV from a first prototype in the 1950s to become the largest source of capacity additions was accompanied by continual innovation, and that's indicated here on the chart by the patenting that preceded deployment. So, yes, policies to support PV deployment, the massive scale-up of manufacturing and economies of scale in places like China, they've been critical success factors for the solar PV that we know today, but its roots are very much in innovation. And a similar pattern can be seen for electric vehicles and the oil demand that has been displaced. So we can see this after the inflection point for patenting, which is a proxy for cumulative invention, and we see that oil displaced has increased noticeably. And both PV and electric vehicles have built there on widespread private sector innovation efforts to capture market share, including in countries that were not actually previously major R&D hotspots.
Energy Week 2024.
I want to welcome everybody to this city, Cape Town, to Africa. Many call it Africa. We call it home. Welcome.